Hello Sector Watchers, welcome to the show. This is the 186th episode of Sector Spotlight for Monday the 31st of July. My name is Julius Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. As it is the last day of the month, I am going to do an overview or an attempt to align the seasonal patterns that we can pick up from our seasonality analysis with what we are currently seeing in the markets. We used to do that on the last Tuesday of the month, but with the new format and me recording usually on Mondays, I'm going to use this opportunity to use the last Monday or the last day of the month, which is coincidentally a Monday, to do this segment of Sector Spotlight. I hope you enjoy it. Ladies and gentlemen, this is Sector Spotlight. Before I dive into the actual analysis of this moment, I would like to take the opportunity to show you how I get to my results. Because I get quite a few questions on how I get to the numbers that we're talking about in this segment of Sector Spotlight. And the numbers basically that drive that spreadsheet that I'm using. I'm using for the data that go behind it, I use the seasonality tool that's available on stock charts. And if you go here and you just say you type in SPY and then go, it'll load up. So this is the default. It will give you 5 years worth of data. And it will show you the percentage of month in which SPY closed higher than it opened over this particular period. Now, I like longer term analysis, so I like as much data as I can get. And on stock charts, that's 20 years. So if I draw this slider back, it gives me 20 years of data. And the percentage numbers here are is the percentage of the number of months of in this case January, February, March, etc., where the S&P SPY closed higher than it opened. The one thing that I do is, because as you can see it's now August and it runs through August 2023, and I don't like that. So what I do is I scroll back one notch to get a complete year, and the complete year is 2022. So these numbers are the percentage of months where the S&P closed higher than it opened, and the little number, the little figure at the bottom here is the percentage, the average percentage return for that particular month. So if we look at August, then in 65% of the cases of August, so 65% of the months of August, so that's 20 months of August, 65% of that, the market closed higher than it opened. And the average return for all these 20 months is 0.3%, 30 basis points upward. That is the seasonal pattern for the S&P 500. Now, when I go into sectors, and let's, for example, take, I don't know, XLB, materials, XLB. Then when I run this and I do the same, so I go back 20 and I pull it back, so I have the full year 2022. For August, it shows me that 45% of the time XLB opened higher than it closed, and the average return was minus 30 basis points. I'm less interested in these data. What I'm interested in is how this sector, or how all the sectors did versus the S&P 500. And in order to do that, I stick in SPY as my comparison symbol. And I hit go, and I go back 20 years, and I go full year 2022. Now it tells me that 40% of the time XLB underperformed, or sorry, 40% outperformed the S&P 500. That means that 60% of the time materials underperformed the S&P 500. And the average return for the month of August for the materials sector, the underperformance of the materials sector, is minus 60 basis points. So on average, the materials sector underperforms the S&P by 60 basis points over all months of August over the last 20 years. And 40% of the time, materials outperformed the S&P 500. What I then do is I collect all these data for every sector that we have, and I stick that in a spreadsheet. And that is the spreadsheet that I use in my analysis going forward. And that spreadsheet stays the same for the entire year. So only when December is completed, before I do the analysis for the new year, I stick in all the results in this case. So at the end of this year, I'll be sticking in all the numbers of 2023 to get another 20-year period. I hope that makes sense, and now you know how I get to these numbers and how you could, if you want to, try to replicate that analysis, try to replicate those numbers in your stock charts account. And if you want, I'll be happy to share that spreadsheet with you. Just drop me an email and I'll forward it. No problem at all. Now let's dive into the analysis of the numbers as they currently stand. I have reworked my spreadsheet a little bit. I think I've used it once before in Sector Spotlight, but I begin to start liking this a little bit more, because what I'm doing is I'm breaking down the sectors into these three groups that we use on Sector Spotlight: offense, defense, and sensitive. And by ordering, by displaying the universe in this in this way, I get a little bit of an extra grouping element that kind of helps me, at least, to get a better view of what's going on in the market. So the numbers didn't change, it's just the way how the sectors are ordered across the top. So it's just a sequence. I've highlighted the month of August, obviously, because that's the month that we're going into, and that's the month that we're doing our analysis for. And what you can pretty much see immediately is that there is a lot of 40, 50, 55, and 60 stuff going on. And that means that it is not so interesting from a seasonal point of view, because they're all kinds of flip of a coin, 50-50 chance of something happening. We saw a SPY, 65%, that's quite decent, but the return is not magnificent. 30 basis points is not fantastic. And then when we start with the group of offensive sectors, then we see 40, 40, 50, 50. It just doesn't do it for me. That's way too loose. There's no real significance in those numbers. And if you look at the performance, the average performance, then these are, it's materials minus 60 basis points. That's quite significant. That's quite a big move. Minus 20 basis point, not so much. But 1% outperformance for real estate in the month of August is quite significant. And then we've got 40 basis points for consumer discretionary. Now what it tells me is that basically when real estate is outperforming the S&P 500, it does that really, really strong. And when it's underperforming, less strong. And to a lesser degree, that goes for consumer discretionary. And when consumer materials is underperforming, it underperforms way stronger than it behaves on the upside when it's in a real strong month. That's the way I look at these numbers. Unfortunately, there's not a lot of kind of tradable perspective to get from this group of sectors. If we move on to defensive sectors, it's a bit the same. We have 60% for utilities, 50 for staples, 55 for healthcare. So you could argue that it's, well, no, you couldn't argue. It's middle of the road. It can be good, it can be bad. And if you look at the numbers here, 40 basis points, 20, and minus 30 basis points. There's no real common denominator in this group either. So month of August for offense and defense from a seasonality point of view is probably going to be a write-off. Where there may be an opportunity is in the group of sensitives. And if we look here, then communication services, 40% of the time outperforming, which means 60% of the time underperforming. The result, the average result is 0. So I'm not going to waste any time on that one. This might be interesting. Energy. 35%, only 35% of the time, the energy sector has been outperforming the S&P 500. And when it does that, so 65% is underperforming. And when it's underperforming, or on average basically, it's underperforming the S&P by 1.4%. That's quite a significant number. That's the largest number in the whole month of August. The average return for the energy sector, minus 1.4%, and it underperforms 65% of the time. So that suggests that the month of August is a really weak month for the energy sector. We're going to look at that in a minute. On the opposite side, and it's interesting that it's in this group of sensitive sectors, this is kind of a mixed bag. They don't fit into offense, they don't fit into defense, and they're mixed among each other as well. So here you got technology outperforming the S&P 500 70% of the time in the month of August, and the average return is 70 basis points over SPY. That is also quite a high number. If you look at it, it's the second highest number after real estate for the month of August. So this suggests that the month of August is going to be, or usually is, a pretty good month for the technology sector. And then finally we've got industrials, which is at 45%, not really a big deal, and also minus 30 basis points is not fantastic. So I'm going to put these numbers side by side with the current rotation as we see it on the RRG and see if I can find some matching rotations, especially for energy and technology. So here we are with the analysis side by side. On the left hand side we have the spreadsheet that we just discussed, that is the theory, and on the right hand side we have the relative rotation graph as it stands currently, and that is reality if you wish. Now on the right hand side that is the group of offensive sectors. So I'm gonna go over them group by group. So if we look at offensive, we already discussed that there was not a lot going on from a seasonal perspective. Maybe the 1% average return for the real estate sector is something that we may want to look at. If you look at the rotation, the current rotation, then you can see that the group as a whole predominantly is moving from lagging into improving, which suggests an improvement. And that is what we have already discussed in prior episodes of Sector Spotlight, that the rotation is ongoing to the more offensive sectors. And it was led by consumer discretionary for quite some time. And that is now seemingly giving way. So it's still good, it's still in the in the leading quadrant, and it's still above 100, so there's nothing wrong with the consumer discretionary sector. It's just that it's losing a little bit of its pace, and it looks as if these other sectors are picking up that pace. So they're following the lead that they got from the consumer discretionary sector over the last few months. And we can actually show that by scrolling back through time. And you can see how consumer discretionary has led that group higher. Obviously, it's one of the bigger sectors, the biggest sector in this group, and one of the biggest sectors in the whole universe. But materials, real estate, and financials are now picking up. They're inside improving, and they start moving to the right. So that is a good thing. They're not there yet. They're still at relatively low RS ratio values, but that gives them enough upside potential, so to say. Unfortunately, from a seasonal perspective, there is not much to gain. If we look at the 1% for real estate, then it should be coming from the real estate sector, which is positioned just inside the improving quadrant. It's definitely possible, but it's a bit of a long shot. So inside the offensive sector, I'm not seeing a lot of, at the moment, very tradable or investable opportunities. Let's move to the group of defense. These three sectors staples, utilities, healthcare have been moving in tandem almost the entire year. And that's a good thing because it gives us a coherent view and a coherent idea of what's going on with the group of defense. And the group of defense is something that characterizes investors' behavior. We've used it a lot of times in sort of trying to make a call on the S&P 500 when people are moving into defensives. That's usually bad for the S&P 500. When people are moving out of defensive, that's usually that's usually good for the S&P 500 because they go out of defense, means that they're going somewhere else. They're all three now positioned inside the lagging quadrant, but as you can see, recently they started picking up a little bit of momentum. If we look at the seasonal behavior of these three sectors, then you can see that August is not a fantastic month. And also from a performance point of view, relative performance point of view, they're not showing any very particularly serious performance figures that could sort of entice me to do something with those sectors. So despite the fact that they're picking up a little bit of momentum, they're still inside lagging. They're still way to the left, low reading on the RS ratio scale, and the movement to the right on the RS ratio scale is still very, very limited. So I'm going to judge these hiccups as exactly as that, as hiccups, and leave them for now. I don't think there is any tradable opportunity from a seasonal perspective for this group of sectors at the moment. The values are too low, they're not significant enough, and the performance figures they're not significantly enough to back up any potential trade, if you wish. The last group is the group of sensitive sectors. And that's a bit of a mixed bag, always is, but that could lead to tradable opportunities. Now, interesting stuff going on here. Look at the group of sensitive. So we had 35% of the time energy outperforming the S&P 500. As you know, low numbers, the reverse is the underperformance, and that is 65% of the time the energy sector has been underperforming the S&P 500, and the average return is minus 1.4. That's a number that I'm interested in. If 65% of the time, I like 70 better, 75 even better, but 65 is getting interesting, especially in combination with a minus 1.4. Because it means that when that sector is underperforming, it's really underperforming. And when it's outperforming, it's not underperforming that strongly. So it suggests that August is a very weak month for energy. Look at what's happening. Energy is picking up, and it's actually picking up quite strongly. Over the last 10 weeks, 11.7%, beating the S&P 500. So this is really coming to life. And that makes it hard for me to make that a sort of, from a seasonal point of view, a short perspective, because it suggests that it should be underperforming, but the reality is that it's actually starting to outperform. It's moving into the improving quadrant, and there is no sign at the moment of any rotation to the other side. So unfortunately, we have to sort of abandon this. It can be on the watch list because I'll show you a little bit a different approach in a minute. But for the time being, there's no straightforward upfront opportunity saying, hey, you got to be short energy, because you shouldn't. It's moving into the improving quadrant and it's picking up. The other sector in this group is technology. Technology outperforms the S&P 500 70% of the time during the month of August. And on average, it's beating the S&P 500 by 70 basis points. If you just look at these numbers, you would say that, hey, August is a very good month for the technology sector, and I'm expecting a 70 basis points outperformance over SPY. Now look at the actual rotation. Here is XLK, just coming out of the leading quadrant, moving into weakening. That is not a tail, that's not a heading, that's not a direction that I associate with a strong month of August, with a strong upcoming month. When I look at this, it sort of suggests that there is more weakness to come. It's still a strong sector, we're still on the right-hand side, but there is a loss of momentum. And this is a weekly RRG, so it can easily take a couple of weeks if you just fantasize in your head, and you've all seen these RRGs. You know, if this moves on for 2, 3, 4 weeks, we could be here, and we're still inside the weakening quadrant. Not necessarily super bad, but you know, underperforming the S&P 500 for a brief period of time, while the trend is still up, because that's what it means. When you're on the right-hand side of that graph, the relative trend is still pointing upward. So again, here we had no ideas, and here also, so in offense and defense, there are no ideas because the odds just don't stack up. And when they do, for energy and for technology, the reality is telling us something different. It's very hard to sort of position yourself on the long side for technology and on the short side for energy, where you see the tail of energy moving upward and the tail of technology moving downward. The reverse is also true. If I see these tails and I see these seasonal numbers, I'm quite reluctant to put on an all-out long position in energy and an all-out short position in technology, because I know that the seasonal odds are against that trade. So how can we turn this into something more meaningful and potentially more tradable or investable, if you wish? What I did is I looked at because let's go back. When would this become very interesting? When energy rolls over inside improving and starts to move down, and technology curls back up and starts to move back up, then it would completely align with what we're seeing in these seasonal patterns. When XLE rolls over and starts to move down, we know that that's usually a very weak sign. And when XLK turns back up and starts to move back up to leading, we usually know that that's a very strong sign. So when we see that, that could be a trigger to actually go with a seasonal driven trade. Let's take a look at how this chart looks on a daily scale, going a little bit more granular. And now, when we look here, we see energy. So this chart is completely confirming what we are seeing on that weekly. We see energy shooting off into the leading quadrant, confirming that strength that we're seeing on that weekly, and technology is moving into the lagging quadrant, completely confirming that weakness that we're seeing on that weekly. Now, here's the thing, and I'm gonna actually tick off industrials and communication services. That makes it a little bit more visual, like that, fit it. So what would I be looking for right now? So when, if and when in the next few, it should happen in the next probably week, week and a half, 2 weeks to make sense. If we see energy rolling over inside the leading quadrant and start heading towards weakening and then lagging, and we see technology making a reverse rotation, so go through lagging, pick up, and start moving into that northeastern direction, that could be a trigger, because then these tails are starting to align with the suggested seasonal patterns. So not anything at the moment, but I'm closely watching both the energy and the technology sector for a reversal on the daily tails of the RRG, where XLE should start rolling downward and start heading into a southwestern direction, and where XLK starts rotating upward and start heading into that northeastern direction. When that happens, there is an alignment between the seasonal pattern and what we're actually seeing on the RRG, and that might be a tradable opportunity. And that wraps up Sector Spotlight for today. Sector Spotlight is available on demand on the StockCharts YouTube channel, usually recorded and uploaded on Mondays. Feel free to share your thoughts, ideas and/or comments below the video. I hope you enjoyed the show, and I'm looking forward to seeing you again next week, same time, same place.